Welcome to the webinar today. Thanks everyone for joining. I'm your host for today's webinar and our topic is cost segregation. Today we have a very special guest, Yona Weiss, with us. My name is Vinky Loomba. My company name is Loomba Investment Group. I'm in the commercial real estate space, special focus on multifamily investing. So when you're in the commercial real estate, regardless of the asset class, cost segregation plays a very big role. It brings us a lot of tax reductions. And that's the reason we have Yona Weiss with us today to walk us through the whole process, how it works. I actually host educational webinars every other week on Fridays at 3 p.m. Pacific time. I try to bring some interesting topics on multifamily investing and syndication, and also bring some great guests who are the subject matter experts. So before we get started with this webinar, I would like to go through a small little disclaimer. This webinar is strictly for education purposes and should not be considered as a legal, accounting, or investment advice. This webinar does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. The strategies mentioned in the presentation may not be applicable for everyone. The information presented is believed to be accurate and reliable. We make no representations or warranties expressed or implied as to the accuracy of such information, and we explicitly disclaim any and all liability that may be based on such information and or errors or omissions thereof. Please consult with your attorney, financial advisors, and CPAs for any legal matters, investments, or specific tax situations. Once again, this session is strictly for knowledge sharing and educational purposes only. Some of the housekeeping items, please use the Q&A box for any questions instead of the chat box. We'll try to address all questions after the presentation. If we didn't get to your question for some odd reason, please send an email to winky@loombainvest.com and we'll provide you with the answers. This webinar will be recorded and recordings will be sent out to all. Recordings will come from winky@loombainvest.com. To avoid the emails to end up in your spam or promotions folder, please whitelist my email address, meaning add me to your contact list. How to reach me? You can connect with me through my website, loombainvest.com. Also, please feel free to download a free ebook at my website, 7 Reasons Why Syndications Build Long-Term Wealth. You can also connect with me through Facebook, LinkedIn, Instagram, and also you can call me directly at 250-3907 with area code 925 or through my email, winky@loombainvest.com. Let's welcome our today's special guest. Today we have an awesome guest, Yona Weiss. So a little bit about Yona. He's a director at Madison Specs. Yona is a powerhouse with property owners' tax savings. As business director at Madison Specs, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars in taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and a host of the top podcast, Weiss Advice. Welcome, Yona.
Yeah, there you go. I appreciate the intro and great to be joining you.
Sure. So are you ready to roll?
Let's do it. Yeah. I got my slideshow over here. Let me share my screen and we'll just get to it. If anyone has any questions, make sure to put them in the chat box and we'll get to them at the end. So Vinky, you'll make sure to get all those questions. And if we don't get them, you'll know where to find me, right?
Exactly.
All right, here we go. So this is the magical world of cost segregation. That's why I like to call it, because for a lot of people, it is like magic. It's like you sprinkle fairy dust on something and you get all these huge tax savings. It really is. It's incredible for a lot of people. So a little bit about, who I am. As Vinky mentioned, I work for Madison Specs. We're the largest national cost segregation firm working in all 50 states. We've done over 17,000 studies across the nation, all different asset classes. And we're going to get to all the nitty-gritty details of what cost segregation is and who's it for, why I should be using it. So these are basically the topics we're going to be covering today. A brief overview of depreciation in general, because cost segregation is really just a form of depreciation. What does that even mean? We're going to get into what are the benefits of doing this, bonus depreciation, which is a big topic. A lot of people talk about that and think it's actually something different. It's not. It's the same thing. We'll get to that. Who should be doing this? When should you be doing this? What's that real estate professional, which is actually the best thing out there? So we're going to get to all of this stuff. We'll do a short case study so you can see actual numbers and see what you can walk away with. Whether you're an active investor, a passive investor, this is going to be really informative on many different levels. And regardless, it's always good to learn different topics within the real estate, even if it doesn't necessarily apply to you right this second. So without further ado, let's just jump right into it over here. So depreciation, it sounds like a negative thing, right? When you hear the word depreciation, immediately, if you don't know anything about real estate and taxes, usually it sounds like a negative thing. Okay, something's going down in value, right? I don't like assets to depreciate. I want them to appreciate. I want them to go up in value. So the amazing thing about real estate is that intrinsically, it's like the only asset in the world that intrinsically goes up in value as time goes on, right? Because we're not making any more land, no more property. Your property is going up in value. However, the IRS gives a tax deduction, and many countries have this as well, but the IRS has something totally different, as we'll see shortly, that you can take a tax deduction, a tax write-off based on the principle that your property is going down in value. And so that's this special tax deduction that's based on the concept. And so we call it depreciation, even though it doesn't really mean your building's going down in value. Okay, so that's the first thing to remember. Depreciation does not mean something's going down in value. It means a tax deduction for the building value. And so you're allowed to now take, once you buy a building, the day you buy it, you now get to start taking the value of the building as a tax write-off over a 39-year period if it's a commercial property, or a 27.5-year period if it's a residential or multifamily is included in that as well. So let's see, we'll get to exact details of it, but essentially it means you take a little bit each year. That's your depreciation deduction that lowers your income tax liability and allows you to take bigger tax deductions, paying less taxes. Essentially, that's how we're doing it. However, with cost segregation, we're able to actually break down the building into different categories. We'll segregate out the assets of the building, so to speak, break down that cost, that purchase price, into many different categories. And each category will have different assets within them. And those things you can now depreciate on 5-year, 7-year, 15-year, other different schedules that allow you to take these bigger deductions earlier on. And it may still sound a little confusing now. We're going to clear it up as we go. Okay. And in fact, there was but let's just take an example over here. Okay, let's say you buy a building for $1 million. Okay, the first thing you do is you have to allocate a certain amount for land. 15% is a pretty national average, so that's why I'm using this. As you can see, your depreciable basis, that means the amount that you're allowed to now take as a tax deduction, is $850,000. And this can change. Again, the purchase price can be whatever it is. The land allocation will be whatever it is. I'm just using an average here for an example. Once you have established your depreciable basis, that means now you can take this as a tax write-off, but it's a little bit every year. So what we call straight line depreciation, which is what most accountants do without the cost segregation method, is you take that entire amount of $1 million, $850, and you divide that by 39. Okay, $21,000. That's your taxable deduction. If it's a 27.5 year, that means, again, residential property, you're getting a $30,000 deduction each year. So think about it like this. You buy a $1 million property, it's an income-producing rental property, and maybe you're getting your income, your net operating income is about $50,000 a year. Okay, pretty average, I would say, or probably even below average, $50,000 in net operating income after all expenses. That means you immediately subtract $21,000 or $30,000 from that, and you're only paid taxes on the remaining $20,000 or $30,000. Okay, that's how depreciation works. So right off the bat, it's a great thing. Cost segregation, as we'll see, is a way to actually front load a lot larger amount of those depreciation deductions early on. So in the first year or in the first several years, you'll actually have zero tax liability because that will wipe out your entire income tax liability. So let's get to some of the fundamentals, how this actually works, how we're able to do this by front loading these tax deductions and getting it done. There are principles. This is not some like strange, out there strategy. This is all directly from the tax code. The IRS says that in order to do a quality cost segregation study, you must have a qualified engineer, right, come to the property. We're actually doing this and have checked that we're doing this virtually now. A lot of our properties, since the pandemic started last year, we started taking virtual tours. So our engineers are still going there, but just through a video conference, et cetera. But they need to actually go and see the property. You need to have documentation, that pictures, that videos, that it was actually done. Once they do that, it's like an appraisal. So literally looking at every single detail of the building, of the property inside and out, and identifying certain assets that depreciate faster. And we'll get to some of those categories of what those things are exactly. We're breaking that out. Certain things like personal property, even landscaping, you see this picture over here, that depreciates on a faster schedule than the structure. That's the main 27.5 or 39 year. We're able to take those tax deductions, accelerate those tax deductions up front, and then give you bigger tax deductions. Okay, so simply put, cost segregation is a cash flow mechanism. Okay, it allows you to have bigger tax deductions in the earlier years of ownership. Paying less tax means you have more cash flow. Okay, this is the principles of cost segregation. So what are those assets that I keep talking about? Breaking out these assets, reallocating assets. So there are three main categories when we look at any property. Okay, there's the building, the structural components, and that can include like the building, foundation, roof, windows, doors, electric, infrastructure things. All of that is going to be the main bulk of the property. That's where the main value of any property goes into, and that depreciates on the 39 or 27.5 year schedule. And so it's actually a mistake to lump everything in there on that 27.5 or 39 year schedule, because there are things inside that depreciate, as we'll see here, on a 5-year schedule or a 15-year schedule. And these are the two other main categories besides for the structure. There's 5-year, which is considered personal or tangible property, things that are inside the building that are non-structural. And so it doesn't necessarily mean things that are actually movable, because you can see certain things like carpeting or even millwork. But equipment, furniture, appliances, things like that, anything that's inside the building that's non-structural, even if it is attached, so cabinets, countertops, things like that, even though it's attached, it still is considered personal 5-year property. We identify what all of those things are in the building, create a very detailed report, assigning a value to each of those items, and then taking the depreciation deductions, the value of that as a 5-year depreciation schedule. Okay, so we're going to get to exactly how that translates into your actual bottom line. The second category of those classes are that are reallocated are really, that's the 15-year property. So again, when you take a building, you're looking at really in different components. And it's actually, cost segregation used to be called component depreciation, which is a much better name for it, because that's essentially what we're doing. We're not depreciating the whole thing as once. We're not taking those tax deductions. We're depreciating each component separately. So the third category, like I said, there's the main structure, then you have the personal property inside, then you have 15-year, this is called land improvements, and not to be confused with land, right? Land does not depreciate. You cannot take the value of the land, but everything that's on top of the land outside of your property, like pavement, concrete, you see all the things on the list over here, landscaping, even retaining walls, if you have any sort of playground equipment or landscaping, etc., fencing, all of that stuff is outside the building, has value to it. I mean, you think about some, beautiful properties have lots of beautiful landscaping, garden style apartments have a lot of this 15-year property. Again, this stuff has value. We identify what the value of all those individual components are. Then you can take that as a 15-year tax write-off. Okay, so instead of lumping the whole thing together over 27.5 years, you can front load, and we'll see how much it's going to be, maybe 20, 30, 40% of the actual building value into these faster categories, getting you much bigger deductions. Okay, so these are some of the things. There are certain other year schedules like 7-year or 10-year, but there's almost few and far between, especially in multifamily properties. Those are almost non-existent. There are some commercial properties that have some 7-year or 10-year assets, but for all intents and purposes, 99% of reclassified assets fall into the 5 and 15-year category. Okay, that's why I didn't include 7 years. It's very uncommon, especially in multifamily. So what are the types of properties that have the most or have, just what type of reallocation are we talking about? Again, we're taking that tax basis after you've allocated for land. How much of that can we realistically take as a tax write-off in those earlier years? And I will point out one thing which we're going to get to shortly, which is bonus depreciation, which actually allows you to take that entire amount of that accelerated depreciation in the first year as a lump sum deduction. So it's important to realize, like, how much am I going to get? Either I'm going to spread it out or I'm going to take it as a lump sum. Either way, I want to know how much that's going to be. So on average, apartments, multifamily, we're looking at, about 25 to 30% on average is what, closer to 30% of how much there could be. There are certain types of multifamily where they're more city properties. There's very little to no land improvements. It's going to be much less than that, right? Because you're only going to be allocating to personal property. There are other types of properties that have beautiful landscaping, lots of land improvements, very high-end luxury. You can get up to 35, even closer to 40%. And so these are, really important to note. The average, again, about 25, 30%. Auto dealerships, you have all kinds of properties. So cost segregation can be done even on single families, can be done on any property as long as it's not your personal residence. Even a business property, which many people don't think about. Hey, I'm not a real estate investor. I might be a doctor that just owns the office building that I work out of, right? That my clinic is in. Guess what? That is considered a business property. You can take your depreciation deductions on that, and you can do cost segregation on that. Similar, like a warehouse, a manufacturing facility. You may be in business and may not know that you are supposed to be taking depreciation and can do cost segregation to help your business income. Again, this is just another great tax strategy to help you lower your taxable income. But again, you can see lots of different properties here. Hotels have a little bit more, right? Lots more furniture and fixtures, things like that. Grocery stores, etc. Mobile home parks, which is the second to the bottom over here, you can see are literally off the charts. We're looking at an average of 60 to 80% of reallocation. And the reason why that is, and mobile home parks are similar to golf courses in the sense that they are unique in that there's very little structural components there. So the 27 or 39-year property is almost non-existent. So what are we looking at? We're looking at land, which land doesn't depreciate, but of the amount that's not land, what are we left with? We're left with land improvements. Okay, so that's really important. You just have the land improvements. You have landscaping, you have pavement, you have concrete slabs under each home, under each trailer. That's the majority of what you have acquired. And again, it's really important to remember depreciation is based on your purchase price. You allocate a certain amount of land and it starts the day that you place that property in service, the day that you start renting out or your closing date, whatever that is, that's when depreciation starts. It's not intrinsic to the actual building, or the property, it starts when you buy it. And so that's the incredible thing. Again, how depreciation is it's not intrinsic. It doesn't mean your property is going down in value. It means you now get to start taking the tax deduction day one when you actually buy that property. As you can see, warehouses have very little because, again, there's not much inside. If you think about warehouses, usually just building, maybe some shelving, some electric, and that's about it. So just to review over here, what are we talking about? What are the basics, right? It is a time value of money play because what are we doing? We're reducing our taxable income. We're taking bigger tax deductions earlier on. We're not creating deductions out of thin air. What we're doing is we're taking that, the $1 million, and instead of taking a little bit each year, 2 to 3% each year, we can front load 25% of that in the first year. That means in the later years, you will have relatively less. You'll still be depreciating that 27.5 structural component each year. So you will have less. But what that's going to do, it's going to reduce your taxable income and hopefully to zero. That's really the goal, pay zero taxes. And that gives you more cash flow. That cash flow, you can now reinvest. It's an incredible process. And this is probably one of the main strategies that people like, real estate moguls and things like that are able to scale and able to create wealth so fast at a much faster scale than other types of investment vehicles because there is very little to no taxable income. So you can get a lot of benefit and pay no taxes on it. It's just a great play. So let's talk about who should be doing this, right? First of all, we're going to get to the real estate professional in another couple slides. That's really who should be doing it. And I'll tell you why that is when we get to that. But really anyone can do it. Okay. It doesn't matter how the property is owned. If it's a business structure, if it's a trust, an estate, doesn't matter. Anyone can do any type of entity, whether it's an LLC, a partnership. it can be done because usually, especially in partnerships or LLCs, the property is owned by a group of people together, and the depreciation is usually split up according to each of those owners. Whether you're active, whether you're a passive investor, you now get your portion of your ownership that gives you a portion of that depreciation. So if you're, let's say in a typical syndication where you are investing $100,000 and you're getting an 8%, preferred return on your investment. So that $100,000 will give you about an $8,000 tax, income during that first year. Well, guess what? You will have a percentage of ownership of the property, and you'll get proportionate to that an amount of depreciation. So if you own, let's say 10% of a $10 million property, right, and you put $100,000 in, I don't know how that's exactly possible, but you got very high leverage, right, maybe, and you're going to get 10% of that. That means you'll get whatever that depreciation is. If the cost segregation is going to get you $200,000 of depreciation, that means your $8,000 income, right, is going to get $100,000. Again, the math is not really clear in my head right now, but you get the point. You get a much larger deduction than your actual income. So what do you do with those extra deductions? That's considered a loss, okay, a passive loss. And whether or not you can use that to offset other income, that's going to depend on whether or not you're a real estate professional, but it still can be used against your other passive income. Essentially, anyone can do it. If you are a taxpayer, if you are a nonprofit, obviously nonprofits do not get this benefit of a government entity, things like that. Or another really important thing to note is if you are investing from a tax sheltered entity like a 401k, right? They call them QRPs, right? Qualified retirement plans. All of those things, or a Roth IRA, those are already tax sheltered entities. If you're investing from within that, you don't get the depreciation benefit because it's already being tax sheltered. So that's another important thing to note. If you are investing from that, this will not apply to you. And if you are buying a property, it probably does not make sense to do cost segregation if you're investing in it from one of those tax sheltered retirement plans. So I mentioned I'd get to this real estate professional definition. This is this is directly from the tax code. The IRS has defined someone who materially participating in real estate trade or business as a real estate professional. And once you have this designation, and you don't need to necessarily be a broker or have any sort of license to do this. This literally is just a test to see how much time you've actually spent during that year, how much, once you pass that test, and you can apply for this, either you or your spouse, only one person from that couple needs to have this designation, and it allows you to use the extra losses to offset ordinary income as well. Okay, so I'll get a little bit to that in a second. Let me just define what this real estate professional is, and then you can see if that's you. If that is you, then you get an extra special benefit, and I'll describe exactly what that is in terms of the passive losses. So essentially, there are two qualifications. Both of them need to be met. Number one, you need to spend the majority of your working time during each tax year. So this is something that's designated each year on its own. More than 50% of your time was spent in the real estate trade or business. What that is in the second column over here, you're developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, or brokering. So any of those activities, if that's what you're involved with on a daily basis, and you don't have another W-2 job, because essentially if you have a W-2, you cannot also simultaneously qualify as a real estate professional, again, unless that is in the real estate business. Because they want you to be full-time in real estate to get this benefit. You need to have, the second qualification is a minimum of 750 hours. So again, they both need to go together, which essentially means you cannot just retire and do nothing and also get this real estate professional designation. You also you have to be spending at least 750 hours a year. It's not a lot, about 16 hours a week if you kind of break it down to that. So you do need to spend time, again, materially participating in these activities. If you're just a passive investor, you will not qualify as a real estate professional because you're not materially participating. This is a topic that needs its own webinar on its own. This is just a slide to kind of get you an idea of what this is. Do your own research. Highly recommend, especially if you are involved in this, you want to make sure you qualify because the tax benefits are incredible. And I'll explain right now what those tax benefits are. Essentially, as I said, depreciation is a real estate tax deduction, and it's considered a passive deduction, which means it goes to offset passive income. Okay, real estate income, rental income is called passive income. So your depreciation is great. You made $50,000 in real estate, $50,000 deductions, great. They knock each other out. You don't pay any taxes. But what happens if you have only $50,000 of income from your real estate and you do cost segregation, you get $200,000 of tax deductions of losses. So what happens to that extra $150,000? You knock off the first 50 of your income, and then you're left with $150,000 of tax deductions of losses. How does that apply? So if you are not a real estate professional, it will be considered what's called a passive loss. It carries forward and you can use it next year, but you cannot use it. You have a limitation of what you can use it for. If you make, in the next slide over here, if you make less than $100,000 a year of your adjusted gross income, you can use any of those extra losses to offset up to $25,000 of active income. However, if you are not, if you make more than that and you're not a real estate professional, it just carries forward. However, if you are a real estate professional and active, materially participating, you can use that extra 150 to offset any ordinary income that you or your spouse has. So if you're, one spouse is a W-2 high income earner, the other one is a real estate professional, you can get the cost segregation, use those extra losses to literally knock off not only your rental passive income, but your active income as well. Okay, so that's the real benefit here of the real estate professional. Some people call it REPS, R-E-P-S, the real estate professional status. You may see that going around in some tax forms and things like that. It is something extremely important. Again, if you have that, it's basically a no-brainer to do cost segregation on any and every single property because creating those losses. If you're not a real estate professional, it really is going to depend on how much benefit you're actually going to get from the cost segregation. Many times it will work. In certain cases, it won't. So again, just to keep this in mind, moving forward, let's get to the next subject over here. So the Tax Cuts and Jobs, it's one of the biggest tax reforms in the history of the United States. And the biggest thing that happened there for real estate was something called bonus depreciation. And it's still in the books today, even though the current administration said they were going to repeal Tax Cuts and Jobs Act. They didn't, obviously. It's still around, right? And what bonus depreciation says is once you do a cost segregation study and have allocated and identified the assets that depreciate on a 5-year or 15-year schedule, right? Faster depreciation, you can now have the option to take all of that amount in the first year. That's called 100% bonus depreciation. You can take 100% of those accelerated depreciation deductions in the first year. So in our example of that $1 million property where you had $850,000 basis, you were taking $30,000 a year of tax deductions without cost segregation. With the cost segregation, you may have gotten 25% of that depreciation in the first year. Now, 25% of $850,000, that's quite a bit. I mean, that's about over $200,000, $212,000 approximately. That means you can take that entire amount in the first year. Well, wow, that's huge. That's called bonus depreciation. Or you can spread that out, the $200,000 over a 5-year period. Again, you're going to be getting much more than your income. You maybe instead of $30,000, you'd be getting $60,000, $70,000 a year for those first 5 years. So again, it makes a lot of sense. And this is called bonus depreciation. It's already in the books to start to phase out in 2023, which means it's going to go down in 2023 down to 80% bonus. And then it will go down to 60% each year, 20% until it is entirely phased out. So you want to make sure to take advantage of it now while you can. Buy properties. As long as you buy a property before December 31st in 2021, you can qualify for bonus depreciation on that property, and you can get a huge tax write-off before the end of the year.
Can I ask you one question here for the bonus?
Absolutely.
Depreciation? So what qualifies for bonus depreciation?
Any property, any asset that depreciates less than 20 years. So essentially that's everything that we're identifying with the cost segregation.
So all the components in an apartment building that's can depreciation 5 years or 7 years, you can just write everything off in the first year as a bonus depreciation.
Correct. Exactly.
Thank you.
Yeah. Awesome. Well, keep the questions coming. So when is the best time to be doing a cost seg study? And we call it cost seg. That's kind of the slang, right? The short, but cost seg, when are we doing it? When should you be doing it? It can be done at any time. And in fact, can be done, doesn't need to be done in the first year. Doesn't need to be done immediately. A lot of people like to get it done immediately after acquiring the property. And many people actually reach out to us. We'll run a free estimate, a free kind of feasibility analysis to see what the property can benefit from a cost segregation study if you want to do it or not. Many people reach out even before they acquire. If you're in due diligence, you're under contract in the property, you want to know what it's going to be. You want to be able to share with your investors what the benefits are going to be. You can reach out to us and we can run that study. It usually takes a day or two just to turn that around. And that allows you to know ahead of time what it's going to be. When should you actually do it? Only once you actually own the property, okay? Because you want to make sure you actually own it, right? You don't want to spend the money to get the study done without actually owning a property. Do the acquisition, and you it's a one-time thing, right? You do one time and you're good to go. You have your new depreciation schedule set up forever, right? At the length of ownership of the property. But as I mentioned, it does not need to be done in the first year. It doesn't need to be done immediately. You can actually do it on a property that was owned owned for many years. And you can do what's called a look back study, which we actually go back without amending your tax returns. You can go back and just collect the extra depreciation that you had missed, that you could have taken of that accelerated depreciation over the previous years, and you can kind of lump it up in this year that you're doing it. So that's called a look back study. Go back and do it if you never did a cost segregation study. The only time that your tax basis will change, it doesn't happen when you do an appraisal and you get a refinance and your property goes up in value. Unfortunately, for tax purposes, your tax basis, meaning the amount you can depreciate, is based solely on the purchase price, right? How much money was spent. The benefit to that is it doesn't have to be your money. I mean, you can finance the property by 100%, right? You still get the tax deduction of that purchase. The only time it changes is when you add more money into the property. So when you're doing renovations, you're making major capital improvements, you're putting a lot of money into that property, the money spent on those renovations is depreciated. And so you can also do what's called a renovations study. If you've done that after you acquired the property, we can now go in and look at how much money was spent and what it was spent on, and now allocate those costs, right? Segregate those costs, if you will, into different categories and get the bonus depreciation for the renovations as well. Okay, just to clarify, this can be done on a newly constructed building as well. It's something we do all the time on new construction properties. Just the same, it's just we're looking very detailed at invoices and at the plans, the building plan, et cetera. How much money was allocated is a little bit easier to do because we have basically the cost, what we're not reverse engineering the property as we're doing with a cost segregation study.
So there is a question on the new construction. So on the new construction, when can you start taking the depreciation, or when you start depreciation right away once you're done constructing it?
Yes, the depreciation starts the day it's called placed in service. Okay, so placed in service means once it is rent ready. Okay, so you may have built a property, and once it's ready to go and you can get it ready for rent, that's when it's called placed in service. That's when your depreciation starts.
Okay, so at that point, if you find somebody else to purchase that property, somebody else bought it, so the new owner can come in and he can start from the scratch again for the depreciation perspective?
Yeah, absolutely. So again, depreciation starts over brand new. The whole schedule starts over fresh when you buy a property, a new owner. So it has nothing to do with how much was taken beforehand. You buy a property, you now get to take depreciation starting day one when you buy it, when you place it in service, on that 27.5 or 39-year schedule, starts over fresh and is based on your purchase price. So you may have bought a building for $1 million, depreciated it. In 5 years, you sell it for $5 million. Okay, the new owner gets to start over his whole schedule based on a $5 million depreciation.
Oh, okay, and that's regardless of whether it's new or the existing value at that you bought.
Exactly, regardless of whether it's new or not.
Thank you.
Yeah, I mean, you may have bought a building that was built in 1925. It's been fully, depreciated. So again, it's not intrinsic to the building. Depreciation is just a tax deduction based on that principle that it's going down in value. So that's the important thing to remember here. All right, so let's jump into this this case study here. This is a great a great time to look at this property. This is a 32-unit garden style apartment purchased for $1.75 million. Nice little property. This was a few years ago, so you can't really get something at that price point these days, at least not this nice. Nevertheless, this is his first multifamily and a purchase of many single families, and I want to point that point out there because this owner had tried to do what's called a 1031 exchange, which was selling off all the single families and avoid the capital gains tax by doing a 1031 exchange and buying new properties. Unfortunately, it fell through. He wasn't able to fit the qualifications. There's certain timelines and time restrictions you have to do that within. He missed those time windows and ended up just selling the single families and had a big capital gains tax burden. He was looking at close to $300,000 of capital gains tax. I mean, he made a lot of money. And so when you make a lot of money, you have to pay or you have a bill, at least a tax bill. The reason why I bring that up is because we're going to see exactly from this, he was able to use the cost segregation not only to offset his income tax, but also that 1031 exchange failed 1031 exchange, the capital gains tax. So without cost segregation, this would have been about $54,000 annual depreciation. Okay, again, we're taking the 1.75 million, taking off 15% for land, and then dividing that by 27.5, 54,000 a year. Now he had about $120,000 of net operating income on this property. Now you make that simple calculation, you're still left with about $65,000 or so of taxable income. And we want to try to reduce that. So what we did was did the cost segregation, and we were able to find on this property about 28% reallocated to faster depreciation. So you can see down here, we did the land, 15% to land. We were left with $1 million approximately. That's all in the structural components. The 72% goes into the structure, 27.5-year depreciation. Then you have 15-year property. Again, that's the land improvements, the things outside, landscaping, pavement, concrete, driveways, sidewalks, all that good stuff. 8% over 120,000 going to that. Then the 5-year property, 20%, over close to $300,000, $298,000. So what we did here, we're able to take, the $421,000 of accelerated depreciation, add that to, the regular depreciation that he had from the 27.5 year. And he was able to get, about $450,000 of first year depreciation with the bonus depreciation. What that did was not only knocked out his $120,000 of taxable income from the property, but it also was able to use to knock off the $300,000 of capital gains tax that he had. So this is something really important. It's a tax strategy. You get these extra tax deductions. Depends how you want to use them, but you need to know these options are there and you're able to use them in many different scenarios, not just necessarily from the, the passive income, but if you're a real estate professional, from the active income, if you had a capital gains tax, which is also considered passive gains, you can use the passive losses to offset those passive gains as well. So important note, a lot of people kind of overlook that. There are many different benefits to the cost segregation study. I just want to point that out as well. And so this guy made off pretty happy. Mm-hmm. What you should know about cost segregation is that, again, this is directly from the IRS. There is something called the Cost Segregation Audit Techniques Guide, which goes through step by step everything that needs to go into a quality cost segregation study. And there are 13 principles listed over here that I took from there, that it's not just something you can do on your own. There's a whole study. We create like an 80, 90 page report, which has a whole numbering system, a whole nomenclature. There's a whole, you have to have identification of listings of property in the tax code, right? List each individual thing, like where it's found in the, what's called the MACRIS, the cost recovery system. So you have to know what all those things are, a very detailed report, all the calculations in there, case history, court case history, all kinds of things like that. So you can substantiate how you're able to take all these huge deductions. And that's what we do. I mean, that's what a cost segregation firm like Madison Specs does. And basically that's about it. I mean, just a little bit, if we take a second about us, we're, biggest national cost segregation company, a lot of tax savings, $3 billion and more in tax savings done. And that's it. If you want any questions, Vinky, what you got for me?
There's a bunch of questions for you, Yana. One question is, let's ask you this right now about the 1031. So I know there's a lot of cost savings in 1031. And when you're taking these tax deductions on a property, and when you exit the property, there is some gain, right? So is there some recapture that needs to happen? Can you shed some light on that too? How does that work?
Absolutely. Yeah, great. I'm glad you brought that up. There's something when you sell a property, there's, besides for the capital gains tax, if you made a profit on the sale, Then you have capital gains tax. There's also something called depreciation recapture tax. So that's considered unrealized gain, which means that you took that benefit. Now you have to pay a tax, or you're subject to a tax on the sale of a property. It's called recapture tax. Now, a lot of people get this confused and think recapture means I now have to pay everything back. It's not true. It means you're not taxed on the amount of depreciation you took. So by doing a cost segregation, yes, you will have a bigger tax bill on the sale of a property. There are several ways to reduce that, defer that, eliminate that. But yeah, it's definitely important to note and to kind of put into your business plan. If you're planning a cost segregation study, how long am I holding this for? Is it going to be something I'm going to have to pay that recapture tax, or how can I get around that?
So for a passive investor perspective, let's say if I'm getting a K1, like for example, I got a couple K1s. Let's say I got a K1 for this year for maybe 50,000, and that I got another for 20,000. Like I'm getting that throughout 5-year term. And
Right.
So by the end of year 5, let's say if I invested 200,000, so it's just like I took the deduction almost the same amount. For me, when I got the $200,000 as a profit, on my investment. So how much tax do I have to pay on that? Because I already didn't pay tax on all the depreciation that I got. So this is the question one. The second part of the question is, can I take that 200,000 and reinvest as a 1031 exchange to avoid or delay the tax?
Yeah. So excellent question. I'm not sure I can answer the entirely. It may depend on some other factors there, but yes, to answer the second part of the question, the depreciation recapture tax can be deferred with a 1031 exchange. So just like capital gains tax is deferred, that recapture tax is deferred as well. And
so you can defer that. Okay. So, but if you don't do that, then you have to pay the recapture tax, and how much that will be on the whole 200,000? Or is
it? Not necessarily. So yeah, it's going to be on however much depreciation was taken. So if it's $200,000 depreciation taken, then you're going to have a tax on that amount. So it can be a 25% tax. There are other tax rates as well, depending on your situation. There are many operators, and most accounting firms do something called a partial asset disposition, which if you've done a cost segregation study, it actually allows you now to reduce the amount of depreciation that was taken of the faster depreciation, so that you're not hit with the recapture tax on that amount. So let me give you an example. Held the property for 5 years. Let's say you took 20%, $200,000 of that $1 million property in the first year, first 5 years, whatever it is. Because you've identified that stuff as 5-year property, right? You can now say it's been, after 5 years, it's been fully depreciated. And so therefore, once you fill this form called partial asset disposition, you can now, all that stuff that you've taken with the cost segregation, you can lower that on the sale, which means you won't have the recapture tax on that amount. So it's actually, you're only going to be left with the recapture on the amount from the building and the structural components, et cetera. So that's one thing that a lot of people do. Again, it's not too complicated, but a little bit more advanced in terms of tax planning. Most people do. Another thing to note is that when you say you have a tax or you have a tax bill, it doesn't mean, I'm very careful to say this, right? Being subject to a tax doesn't mean you now have to pay the tax. There are other tax strategies. Again, if you have another property you did cost segregation study on in the same year you sold a property without a 1031 exchange, you may have, right, this recapture tax, but you also may have a lot of passive losses from the other property. And those passive losses, guess what, can be used to offset that gain as well. So there are, if you're in a vacuum and you're just looking at one property and that's all you have, then you need to be aware, yes, you buy it, you sell it, you're going to have the gain, move on to the next one. But if you're in a kind of ecosystem where you have many investments or multiple investments, many losses from one can be used to offset gains from another.
Great. So another question I have is, you showed us this non-real estate professional slide. If you can go back to that slide and explain it one more time. When you are a non-real estate professional, how much deductions can you take?
Right. So this slide you're referring to over here. It's only if you have an adjusted gross income of less than $100,000. If you're not a real estate professional, you can take up to $25,000 of those passive losses against the active income. But if you, and this is between 100 to 150,000, once you hit $150,000 of adjusted gross income, you no longer can take any losses against your active income. So it kind of phases out between $100 and $150,000, that $25,000.
Oh, interesting. So another question is this person is asking, is there time limit that you can get the tax deductions for a certain amount of time, or does it like kind of infinite? You can do it anytime.
Yeah, it's a great question. I mean, does it expire or anything like that? No, the answer is no. Once you take those losses and you don't use them, like you said in your example, you have this huge amount of losses, not that much income, they carry forward. So even if you don't use it this year, it carries forward to next year. And that carries forward all those extra losses indefinitely until either one of two things happens. Either one, you sell the property, because when you sell, any suspended losses get released. And then again, you can use them in this current years to offset other income again, or if you use them up. So that's what happens with those losses. But I'm not sure if that was your question, or your question was, if you never did the cost segregation study, can you go back and do the cost segregation study? If that was your question, then I'll answer that as well, which there's no limit. You can go back and do retroactively a cost segregation study in a property you've owned for, I'd say it makes most sense if it's, less than 10 years, 5 years or so. But because once you start getting more, you've already taken so much depreciation, there's not a lot left to reallocate.
So you can go back and forth either way. Thanks for answering both ways. Let me see if we have any other questions. Let me look in the question answer section. You did answer the recapture. And there's the smaller properties. Like you said, even the residential properties, you can get some tax deductions or you can depreciate. So let's say if you have a duplex or fourplex, so some of these smaller properties, they do have a HOA, the homeowners association. So they manage the outside. How does the depreciation work on that?
Right. If you have a condo or something where you don't actually own the land or land improvements, then essentially all you're going to own is the building and kind of walls in. So you won't have any in a situation like that, where you have like a condo, right? You won't have anything allocated to land if you don't actually own the land, and there won't be any land improvements. So you'll just basically have your purchase price, your cost is going to be between the building and the personal property. And that's all it's going to be. But yeah, there can be a lot of benefit there. I mean, again, the main thing is, can you use it, right? It's one thing to do the cost segregation to get those extra deductions, is another thing, can you use it, right? If you're a real estate professional, or you have other income from other properties and you want to offset that, that's where it's going to be most beneficial. Otherwise, it may not make sense unless you have a large amount of income coming in. This is something I see a lot lately with short-term rentals, Airbnbs, these kind of things, a huge amount of income. So people, even though they're not necessarily real estate professionals, and that's actually another loophole there as well, that short-term rentals can, you don't even need to be a real estate professional to use the passive losses against a short-term rental. But besides for that, they're making huge amounts of money. I mean, I know people that are making, $5,000-$10,000 a month on short-term rentals. So yeah, to get the extra depreciation is going to be extremely beneficial.
Wow, so that's a good point. So you can do the cost seg on the Airbnb too, because you're getting all the interiors, right? Either when you're renting or buying, you're trying to just get all the furniture and all the fixtures, everything in to make it look nice. So you can
for sure,
do the short-term rental. So you can do the cost seg. Let me see if we have any other questions. So I'm going to remind our audience one more time, if you have any more questions, please put it in the Q&A box. When you say you can do the look back on the cost seg if you didn't do it initially. So you can go as far as since you bought the property, let's say I'm year 5, I can go back 5 years and I can still run those numbers again. I do not see any more questions. Thank you so much for this presentation.
My pleasure, Vinky. And if anyone has any other questions, feel free to reach out to me. My contact info is there, or you can find me on LinkedIn. Make sure you tell me that you were part of Vinky's presentation, and we can connect there as well.